Did you know that when you sell your home, you may be subject to a capital gains tax because of the increase in value while you've owned it? Calculating capital gains tax in real estate can be complex, but let me give you a quick rundown. Hi everyone, it's Cornelius Jackson. The tax rate depends on many factors, including your tax bracket, marital status, how long you've owned the house, and whether it was an investment property or your primary residence. If you sell a house in less than 1 year of owning it, the short-term capital gains is taxed as ordinary income, which can be as high as 37%. Meanwhile, long-term capital gains for properties you owned over 1 year are taxed at 15 to 20% depending on your income tax bracket. Keep in mind that the tax only applies on the profit itself. For example, if you bought a house 5 years ago for $250,000 and sold it today for $400,000, you will be taxed on the profit of $150,000. Furthermore, the IRS gives you a tax break if the property you are selling is a primary residence. For example, you can avoid paying capital gains on the first $250,000 if your tax filing is single, and up to $500,000 if married filing jointly. You would need to verify that you owned and lived in the property as your primary residence for at least 2 years. There are also tax breaks if the property was a rental or additional property. As mentioned, this can get pretty complicated, so it's best to connect directly with a real estate professional like myself to learn more. If you have any questions, let's connect.